Welcome to Premium Cashflow Real Estate Investing Podcast with Sakar Cowley. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, Sakar Cowley, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, Sakar Cowley.
Welcome to another edition of Premium Cashflow Podcast. Today, I have the pleasure of speaking with Travis Watts. Welcome to the show, Travis. I appreciate your time today.
Well, thanks so much for having me. Thrilled to be here.
Awesome. So Travis is Director of Investor Relations with Ashcroft Capital. Ashcroft Capital is a large multifamily syndication firm with close to $1 billion in assets. But previous to the Director of Investor Relations position with the company, Travis has been investing in multifamily passive syndications and passive investor opportunities for quite a few years. He has invested in 28 different syndications with 14 different companies. So today it is going to be quite a delight to talk to Travis and understand all the different advantages and different things he has, encountered and his experiences today. So we are looking forward to the conversation, Travis. Once again, welcome to the show.
Likewise. Thank you so much.
Thank you. So help us get started, Travis, as to, your your background and how you kind of came into the realm of passive investments.
Yeah, happy to share that story. I guess really the story starts as far back as high school for me. I was visiting my dad one summer. My dad's a very frugal individual, and he was out garage sailing one morning, and he picked up a book of Rich Dad Prophecy. So a lot of people get started with Robert Kiyosaki's Rich Dad Poor Dad, right?
Sure.
But this was Rich Dad Prophecy, and it was my first perspective into the world of finance and investing. Prior to that, I really had no exposure. So all that book really told me was we're going to have a stock market meltdown at some point. So don't invest in the stock market. I mean, that was really like the practical takeaway. So I kind of took that to heart. Obviously, no other perspective out there. So I thought, okay, I'm just not going to do that. And I did want to get into real estate one day. I just didn't know exactly how or when or what that would be like. So what happened was I was kind of setting mostly in cash. I'd always been, an avid saver and budgeter and all these things, just thanks to my parents ingraining that in me. And so 2009 rolls around after we've just had this crazy downturn and recession. We're not yet out of the woods at that time. Things are still looking pretty grim, as you know. But I was taking a look at a house in Colorado. I was born and raised in Fort Collins, Colorado, about an hour outside Denver. So I found this home that previously sold for $165,000. That was now $95,000.
Wow.
And at the same time, the government's handing out $8,000 tax credits to first-time home buyers that you don't have to pay back. So I thought, well, if there's ever a time to get started, I guess it's now. I don't know. Right. So I took a leap of faith, obviously had some fear and whatnot, but, I just wanted to get involved. So I started house hacking, renting spare bedrooms. I later got into fix and flips and buy and holds and vacation rentals. I did all this active single family stuff to a point that I quickly burned myself out. And the reason that happened was I was working an oil field job. So this was 14-hour days, 98 hours per week. It was 7 days a week. I did have days off here and there, but they were few and far between. So you can imagine my spare time, right? And so as I'm browsing neighborhoods and looking at deals and talking with brokers and realtors, it just became too much of a commitment. So, after X amount of properties, I thought, you know what, I can't scale this like I had hoped to. Didn't have the knowledge or the mentorship to know how to. And so I burned out. And so I thought, okay, what is it I'm really after and why? right? I had to do a lot of self-reflecting. I had to kind of go back to the drawing board and think, I love real estate in general, the asset class, the passive income, right? And the concept. What I didn't love is being in the business of real estate. I just wasn't very good at it, quite frankly. And, I was no kind of player out there. You know what I mean? There's just people all around me being more profitable, more efficient, finding better deals. I couldn't really compete. So I thought, why don't I piggyback off the success of someone that does know what they're doing, right? This is where I was learning about syndications, private placements, the ability to partner with folks that are passionate about being in the business of real estate, whereas I just kind of want to kick back and receive the benefits without having to do anything. And so I made a big pivot, 2015. So it was 2009 to 2015 was all active. And I made a huge pivot from 2015 through today to be a full-time passive investor. So I have no interest in doing my own deals or raising capital or doing anything like that. So that kind of is my story in a nutshell, and kind of when and how that happened.
I see. Thank you for that detail. And basically you're sharing there, Travis, is that you were sold on the benefits and sort of the stability of sort of what real estate can do to your portfolio. It was just the mechanics, the minutiae, and all the day-to-day stuff that you were just completely not wanting it, and trying to just get out of it and basically just move towards passive investment. That sounds like what you were sort of driven towards. Now, did you sell all your sort of your active single-family houses, Travis, or you still maintain some of them?
Good question. Yeah. So I completely shifted models 100%. So I sold between 2015 and 2016, a little bit in 2017. I got rid of everything that was active.
I see.
Including owner-occupied home. So I just went all in, and my wife and I, we rent, and we go all in with syndications and multifamily.
Wow, you're all in. You're all chips are in. Awesome.
They are.
Now, help us understand, Travis, that you have, now so far, as I said in your intro, that you have invested in sort of 28 different syndications at 14 different operators so far, right?
Correct.
Give us a sense of, how you sort of look at deals, operators, markets. What sort of, when you see a operating memorandum, sort of given to you, what goes through your head? Like, how do you analyze all those details?
Yeah, it's a great question. I think that it always starts with looking inward first, right? Knowing yourself, knowing your risk tolerance, knowing your investing criteria. I like, for example, B and C class, value add, stabilized assets, right? In particular states, at least. I mean, I do like obviously more specific markets, but in general, I do a lot of macro level research, migration trends and where companies are relocating to and things like this. So landlord tenant friendly laws, stuff like that. So I kind of have a general sense of where I like to park capital, but I can't be a master at every submarket in every state, So from there is where I let the syndication group, the sponsor, kind of fill me in on why Irving, Texas, for example, might be a place to consider versus Houston, Texas, or a suburb of Houston. There's just so much detail involved. So that's kind of how I approach it. So my point being, I get a lot of deals sent my way being a full-time passive. The word's gotten out that I invest with a lot of people. But most of that can be sorted out immediately or filtered out, I should say, because it doesn't match my criteria. If someone sends me a new development deal in San Francisco, I'm not doing that deal. That doesn't match my criteria. So it makes it a lot easier when you start kind of with your goal in mind and you understand what you like and what your preferences are. From there, I look for track record, experience, just in general, getting along with the sponsors. It's a relationship business, right? I'm trusting these people, number one, where I'm placing my capital to make decisions on my behalf. Number two, I'm going to have to communicate with these folks for years. So if there's a misalignment there, or we're not aligned in philosophy, or, whatever, they're not being transparent with me, that could be a big red flag, and that's not going to go over well for a 5 to 7 year relationship. So that's kind of how I view it, macro level. going into a deal.
I see. I see. Now, are there any specific benefits or about the deal that you look for? You mentioned value add, but
Mm-hmm.
value add in general, as we all know, can come in many different forms.
Mm-hmm.
One could be a super distress, or one could be,
Yeah.
just simple
Mm-hmm.
things and stuff like that. So how do you kind of go through or clutter through all that noise as to, what's safe or what's extreme risk, that kind of thing?
Yeah, I think, in general, the consensus is, higher risk, higher return potentially, right? So theoretically, new development deals and things or highly distressed properties
Sure.
should possibly give you a bigger return. But it's weighing that out for yourself and saying, I'm not comfortable taking that kind of risk because what if it doesn't work out? So I like to try to go middle of the road, meaning middle incomes, middle America for the most part, light renovations and light value add, stabilized assets, meaning that upon takeover, the occupancy is say in the 90% range, something like that. So not buying something that's 30% occupied because it has huge problems or it
Sure.
hasn't been leased up yet. And then with the hope of leasing that up. So nothing wrong with those business models, just doesn't match my risk tolerance is all it is. So that's kind of what I look for is B and C class light renovations, where even if you decide upon purchasing the property, we're going to stop doing everything. We're not going to do any work to this property. In theory, it should still cash flow and produce income and hopefully go up in value over time anyway. That's kind of what I look for.
I see. I see. Now, share some stories about Travis that you invested with certain operator and what sort of benefits you have reaped so far. I don't know if you have gone through sort of the full cycle of investments on any of your deals. Give us some sense of what sort of your experiences have been.
Sure. Yeah. So the way I started was, in my mind, the wrong way. And what I mean by that is I would vet the deal first. So a pro forma and projected returns. Second, I would vet the market. And then third, I would vet the sponsor or the operator. So yeah, I know it's laughable. But so what I learned from that experience was, I could share a lot of different stories, but there's one in particular that comes to mind where it was a new operator without a lot of experience. Is probably their second deal they had ever done. But they bought in a great market. They bought at a great price and at the right time in the cycle, right? And so to no benefit of the GP team, we ended up doing very well on that deal, but they pretty much messed everything up. They made all the wrong decisions at all the wrong times and money was misallocated. It was such a mess, and they had to stop distributions and just put the property up for sale at the end of the day because there was enough equity in it to just give everybody a decent return, and they didn't have to keep shooting themselves in the foot, so to speak. So, so anyway, so what I do now is I'm always vetting the operator and the sponsor as number one. At the end of the day, it's really their ability to execute a business plan and to properly, do what they say they're going to do. Number two is still the market. I still think a market can make you or break you alone. And then the last thing is the deal, with the idea being you get the first two in alignment and you're probably going to be looking at a decent deal anyhow with enough experience and a great market. Sure.
Thank you for that detail. And the sour experience that you described, where the operators were probably not savvy enough to make the good decisions or got into some problems. Give us some specifics. And the reason I ask is that there are a lot of passive investors who listen to this podcast, and sometimes all the good Excel sheets and the colorful memorandums that are sort of presented, it all looks great, but sometimes you don't know what you're getting into. So I think it would be valuable for for all the listeners to kind of hear that, okay, what sort of problems are happening behind the scenes that Travis was sort of scared away and they had to just kind of sell the deal. Give us some sort of tidbits about that.
Yeah, I mean, the basic idea here is inexperience is inexperience, right? It doesn't matter what we're talking about. If somebody hasn't gone through it before, hasn't been in something long enough, they're not really going to know what to do when things pop up. Things like a flood, a fire, a hurricane, a tornado, a frivolous lawsuit from a tenant, a property management company that's swindling money. There's all these things that can happen, right? But when you're either partnered with a group that has the track record and experience, or it's a newer group, but they have a mentor or a co-GP, somebody who's kind of over their shoulder to help, that is critical for those reasons. So in this deal that I described earlier that I invested in with the so-called bad sponsor, they had no mentor, they had no track record, they really had no experience, and there was a lot of issues with the property management company. There was kind of a bit of a fraudulent partner to an extent. It wasn't obviously a deal killer because we all ended up making money and getting out of this thing. But it was certainly a hiccup. It was certainly enough of a distraction, it really did kill the deal in the sense that we were going to hold this 5 to 7 years, and 18 months later we're selling it because they don't know what else to do. So, you could go on and on about all the what ifs and whatnot, but you are trusting a team or an individual with your money, right? And so you're just like a financial advisor or anyone else, right? It'd probably be best to work with someone that's kind of been in it a little while or has some resources to reach out to.
Got it. Now you have invested, Travis, with 14 different operators so far. Give us some sense of, what makes different operators good. And share some stories, because I haven't had a guest who, as veteran like you, who has invested in so many different syndications with so many different operators. Give us some sense of your experience as to what you have learned from all these different operators so far.
Sure. Yeah. Again, I still kind of get back to, this is very individual, right? So it's like, what do I value in personality and characteristics and whatnot versus someone else? That's going to be different. So it takes some self-reflecting, but in general, I like monthly reporting because a lot of times monthly reporting and monthly distributions kind of go hand in hand. This is my income. So I'm a big fan of monthly, something that's not necessarily the industry norm in this space. It's mostly quarterly stuff. And the reason is I like to be caught up and informed, not too often where I'm being bombarded by emails every week, but to the point where I don't have any questions, and I like partnerships that are very proactive because I value that in just, human relationships and interactions. So for example, if a tornado comes through Dallas, I own a lot of property out in Dallas. Well, I would like to know as soon as possible if my assets are okay, right? Don't rely on the next quarterly report that comes in 3 months to tell me that there was some damage done and that 8 units got knocked out of line, and now we can't make a distribution or something. That's junky. So being very transparent, the good, the bad, the ugly, share it with your investors. Okay. Don't just try to sugarcoat things. The occupancy fell 10%, but we had a popsicle day last week and everyone loved it. You just got to share it all and just be real. And so transparency, frequent communications, and just good rapport between myself and the partnership, where we can just have a conversation like this and it just makes sense and no one's holding anything back, stuff like that. Is most important to me.
Sure. Now, as we all know, Travis, that a lot of passive investors are busy, like sort of professionals, doctors, lawyers, and things like that, right? So their attraction a lot of times is that, hey, I don't want any hassles, right? I just want to invest and gain whether it's the depreciation benefits and the write-offs and things like that. So in your experience, how have you fared so far in terms of, getting the year-end, of course, you're getting the monthly cash flow or the quarterly cash flow, depending on the sponsor. But give us a sense of the sort of the tax benefits that come along with these investments.
Sure. Yeah. Happy to. And again, just speaking independently as an investor, not on behalf of Ashcroft or anyone, but just,
Sure.
and I'm not a tax advisor, CPA,
Sure.
but yes, you get a tax form that's all done for you. That was a tremendous benefit to me personally when I was doing single family homes, having to track all my receipts and write-offs and constantly calling my CPA. Can I write this off? Or is this some I depreciate? Or, you know, it was just a lot of hands-on, a lot of work, a lot of organizing. It was just overwhelming. So
Sure.
in a private placement, there's just one tax form. It comes once per year. It's a K1, and then everything's done for you, including things like cost segregation and bonus depreciation. And there's a lot of tax benefits that go out there to real estate investors. Every deal that I've participated in, that's been flow through to the limited partners. So I'm participating in this tax advantage. It's not going to the general partnership and I'm stuck with the 1099 or something like that. So, yeah, a simple example of that is that, you know, like cost segregation. Again, I'm no, you know, certified specialist here, but there's a lot of items in real estate that you can accelerate the depreciation on. So everyone kind of knows the 27.5 years of the value of real estate minus the land costs, whatnot. But there's things, you know, plumbing and lighting fixtures and, you know, cabinetry and carpet and appliances. So you can accelerate the depreciation. So you can write the lifespan of these off over 3 years, 5 years, 7 years, much faster than you can 27 and a half. And so that benefit rolls through to the passive investors, specifically in the first year, to where you can have a tremendous tax deduction. So to your point earlier, yes, lawyers, you know, doctors, dentists, you know, professional athletes, business owners, a lot of high income earners, specifically W-2 income, can benefit from these tax advantages, and even more so if you can qualify as a real estate professional. So you have to look that definition up. But if you can qualify with your CPA under that category on your taxes, you can actually take some passive losses to offset active income. It can be tremendous. And sometimes it's a husband and wife situation where, you know, maybe the wife qualifies as the real estate professional and the husband's the W-2 earner. You can both get that category per se. So yes, a lot of tax advantages. I think everyone knows real estate has a lot of tax advantages, but even more so in a lot of cases with private placements, because you can afford on a 400 unit apartment building to do a cost segregation study, which is quite expensive. But, you know, as opposed to a single family home, it may not be cost feasible. You know, your tax benefits aren't going to, you know, outweigh the cost of having that done. So just something to note, there's great tax advantages.
Right. Awesome. Thank you. And also, Travis, like for someone to, you know, understand and get started with knowing, you know, like how to approach the operators or how to find some of these investments, right? What has been your approach? Like, obviously, you know, you probably initially started somehow, and then, you know, you grew your network, and now you probably get a lot of deals sent to right? But let's say if an investor is driving in his car or listening to on his laptop in the night and things like that, and they don't know much about it, right? How can they learn more about it and sort of you know, get to know more operators? What are some of the strategies that you can advise?
Yeah. So for me, leading up to lockdown, COVID, and this crazy situation that we're all in, I was going to a lot of conferences and seminars nationwide, anything really relevant to multifamily apartments, commercial real estate, you know, all this kind of stuff. There's a lot of them out there. I'm the type of person that gets a ton of benefit from that, not only from the speakers and the education content, but being able to network with, you know, thousands of passive investors and, you know, swap notes per se, right? Who have you invested with that you've had a great experience with? You know, any operators I might want to shy away from, you know, and so you pick up a lot networking in person like that. Now, that being said, I didn't start doing that from day one. I wish I had, because I've gotten the most value out of it. But you can also network online. You can also hop on Bigger Pockets and forums like it, or LinkedIn, and you can be posting about, I'm thinking about doing some syndication investing. Does anyone have any, you know, referrals, references? You know, would anyone be open to sharing their experience? That brings me to point two, mentors. If you can seek out someone who's been doing what you want to do, add value, swap value.
Sure.
A lot of people out there, myself included, are totally willing to help and share and connect. So leverage that. That's huge. You can cut the learning curve by, decades sometimes, just by getting right to the point instead of reading 100 different books on the subject and still not knowing what to do at the end of the day.
Sure. And to add to that also, that I think we live in a technology age, like podcasts like this, for example, are also huge. I mean, this is one example, but there are many other podcasts as well. There are a lot of, knowledgeable guests who come on, and as you shared, like having a mentor or listening to these podcasts and things like that are tremendous in my opinion, and they can just absolutely cut down the learning curve in this. So good. Awesome. Travis, a couple of last questions here. I have seen in my experiences that markets and operators are such huge keys that sometimes you can make a lot of mistakes, but just because the market is so good, like let's say the Dallas or the Orlando or the Phoenix or the Tampa of the world, that there's a kind of a saying that they say that is that, hey, I mean, if you're in a good market, it can be a lot more forgiving, and it can kind of ride you through a lot more, sort of the mistakes and things like that. Help us share some of your psychology around, sort of markets, and what does a growing market do to these syndications in general?
Yeah. Good question. And so back to kind of the 1, 2, 3, right? The sponsor, the market, the deal. So when I go macro level on states or markets, we got to think in terms of reality. If we're talking about housing, anyhow, what is it all about when it comes to a tenant being able to pay rent? It's all about jobs, right? So when you're looking at markets, what I'm looking for is diversification in the job market, specifically maybe where there isn't one sector taking up more than 25% of the job market in that area. So you may have some healthcare and some travel, right? And some oil and gas and some, whatever it is, right? So that's critically important. There's endless obvious case studies on Detroit and what happened there with certain properties, or the oil bust back in the day, especially in Houston. It's a little more diversified today, but you just don't want to be limited on one employment center. And there's been deals that I've seen where the numbers look great, but I passed on them because essentially they're parked right next to a huge employment center. And I know a lot of the residents work there. So if that one employment center goes under, that property could be in
the stress,
trouble.
Sure.
So that's kind of what I'm looking for. I'm always looking at like the 3 mile, the 5 mile, the 10 mile radius. Operators are going to share that data with you as to, the schools and the employers and just the stores and shops. You can get a general feel for these markets. If you don't live there, hop on Google Maps, put in the property address and go for a little virtual drive and take a look at what's around there, and if you feel comfortable with it and it checks out, that might be right for you specifically. So.
I see. Thank you for sharing that advice. Now, Travis, given the number of investments you have done and your network with a lot of investors and passive folks in general, give us some pieces of advice that you have learned or from your network that helps you kind of stay disciplined every day. Give us some bit of advice that you have heard so far.
Yeah, I think that the most important thing is just reflecting inward. I talk a lot about just mindset and goal setting and just self-education. You have to just continue educating yourself, and you have to know your goals and criteria. I do speak with a lot of investors. I also speak with a lot of investors that were like me when I was in the single family space, and they don't have a defined plan. They don't have a path that they're really on. It's just, what was I doing back in the day? Why am I doing a flip over here and a vacation rental there and a buy and hold here and house hacking here? None of that really made any sense. But, it wasn't until I really reflected back that really for me, it was passive income I was really about. And then why was I after passive income? Well, I wanted the freedom to leave the job I was working in the oil field. So the passive income ultimately allowed me to leave that job when I had enough to cover my lifestyle expenses.
Sure. Mm-hmm.
And then what that was really about was not money. You know, I used to think it was all about money, but it really was about having options and flexibility to do what you want with your time. So like, I love being part of the Ashcroft team because I get to educate in the space. I get to talk with investors. I get to swap notes. I get to learn so rapidly,
Absolutely.
you know, partnered with a great group. Whereas before I was going nowhere with the oil stuff. I didn't even want to be in that industry. I didn't care about it. It just wasn't me. And so, yeah, it was like, you know, the freedom over your time, I guess you could say.
Absolutely. Absolutely. Thank you. It's been a pleasure, Travis. Please share with our listeners how they can find you and learn more about you.
Sure. Yeah. So there's a calendar link. I spend my weeks connecting with folks on 15-minute calls to 30-minute calls, just doing a Q&A. If anything, you know, resonated on this this interview with your listeners, happy to hop on a call and just discuss it. I talk to 18-year-olds, 70-year-olds, everyone in between, accredited, non-accredited. I'm passionate about passive investing, and I'm happy to connect. I'm also on LinkedIn, Bigger Pockets, Facebook, Instagram. So reach out and let's connect.
Awesome. And we will put the link in the show notes. So we will definitely make sure, you know, viewers and listeners are able to reach you as well using that link. So thank you for your time, Travis. For listeners and viewers of the show, thank you for, you know, all the praise and love, and keep watching. Experts like Travis come on all the time, and we have news and articles at premiumcashflow.com. So please do take advantage. And if you are also looking to you know, learn more about passive investments, we have several articles on the website. And if you're willing to you know, just sort of understand more about it and want to reach out to us, you can always register yourself and reach with us using Invest With Us link on the website. We are happy to, you know, jump onto a brief call and just kind of discuss your goals and what you're looking to do. So it's been a pleasure, Travis. Thank you so much. And I look forward to, you know, talking to you more and hearing more about the future opportunities from time to time. So it's been a pleasure. Thanks for your time today.
Thank you very much. I really appreciate it.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.